course, we've got the one and only Adam Taggart. Adam, welcome to the Resilient Compass. It's great to have you on.
It's a pleasure to be here and an honor to be here on the first one of 2025. There's a lot of people that have worked very hard in their lives to be making money, generating wealth for their families. Some have been quite successful in that over time, but they are looking around the financial landscape and there's a lot of things that are making them feel uneasy. Whether it's the huge spike we've had in cost of living, whether it's lofty valuations that many financial assets are trading at right now, and they read the Wall Street Journal, they listen to CNBC, and they feel like they're getting more cheerleading of what's going on, more pablum, or maybe even just entertainment, as opposed to really factual, actionable information. The only time corporate insiders have been selling at this rate was right before the dot-com bust.
You got to wake up, guys. You got to smell the coffee.
Profit's not a four-letter word. Don't just sit on it because you're afraid to pay taxes when the insiders are selling at a 6-to-1 clip to buying. It may be time to harvest some of that profit, put it in things like gold and silver, put it in tangible items, commodities, pay down your debt, do these things now.
Owning the home is not a keeping a shelter over my head decision. It's simply an Excel decision.
It's great to have a 3% mortgage, but if you lose your job and can't service your 3% mortgage, that's when, as Adam says, you become one hell of a motivated seller. Is Trump on the Trojan horse, or is he the Trojan horse? Is he riding it, or is he? And if you don't look at things through this kind of a skeptical lens, I think after everything we've seen over the last 4 years, I think you missed what we have all just lived through.
Demand for our sovereign debt is weakening. Why is it weakening? Other central banks around the world are making the choice that rather than owning US treasuries, we probably should own something else. And what is the something else they are turning to, right? It's gold.
Welcome, everybody, to the 16th episode of the Resilient Compass. I hope you all had a good Christmas and wish you all the best in 2025. Andy, nice to see you again. How are you doing?
I'm doing well, Jason. Good to see you too, brother. Happy New Year, my man.
Did you have a good rest?
I did. In fact, it's been supremely difficult to even try and get back into reality. I've had to slap myself in the face 3 or 4 times to do, but it's good to be back with you, man. And I'm looking forward to 2025 and riding shotgun with you and see where this crazy ride takes us.
Yeah, it's going to be a phenomenal year. I had a very busy family affair in a couple of different locations, but I finished off with 2-day retreat in a spa. And I've got to tell you, this cold water therapy thing really works. Going into a freezing cold tub of water in the middle of winter definitely wakes you up. So I think you're getting too soft, you're getting too used to that Florida weather, get yourself a cold water therapy plunge bath.
There's a place. So our guest today, Adam Taggart, I saw him in person was in Vancouver at the Vancouver Resource Investment Conference, where he and I will be heading in 2 weeks. And there's a place up in Vancouver, not in Whistler, but up in Vancouver, about an hour away, where it's a retreat like that, a spa I went to, and you go from steam room, hot tub outside into the cold pool. And you do it 3 or 4 times. I don't know that I've ever felt anything more exhilarating. And the way that your skin feels is unlike anything that I can even explain to people. So I agree. Anyone gets a chance to try that out, it's pretty cool.
Yeah, try
it.
It'll
be really good for you too.
Yeah, if you want to be resilient and it comes to your health, Wim Hof and all that kind of cold water therapy, we highly recommend it. Although we're not doctors, and we probably have to have a disclaimer.
But I stayed in the Holiday
risk
last
warning.
night.
Yeah.
For those of you in America, you'll know what I'm talking about. They had those conferences or those commercials where someone would fall on the street and the guy would come above him and be doing this. You got to do this in CPR. And they're like, "Are you a doctor?" And he said, "No, I stayed in the Holiday Inn Express last night." Very funny.
Okay, listen, predictions for 2025. What on earth is this year going to have in hold for us? I'm really looking forward to chatting about that, Andy. But today, of course, we've got the one and only Adam Taggart. Adam, welcome to the Resilient Compass. It's great to have you on.
It's a pleasure to be here and an honor to be here on the first one of 2025. Happy New Year to you guys, by the way, and to your audience. Thanks so much for having me on here, guys. I'm a cold plunge aficionado myself, so completely echo everything you guys said. And Jason, we were talking about before we turned the microphones on here, that no good vacation ever goes unpunished. So we're going to try to give you a nice warm re-entry here to the real world.
Absolutely. So, Adam, you're the one and only founder and host of Thoughtful Money. And I can't have hoped for a better start to the year to be talking with the bullion baron himself, Andy Schectman, and Adam Taggart. But just tell us a little bit about yourself, Adam, for those people who don't know you.
Sure. I am the founder and host of Thoughtful Money, which is a financial media company. What I do is not unlike what we're doing here. I interview top minds in money and the markets on a weekly basis. I do about 4 or 5 deep dive interviews a week. I call it like 60 minutes for money. But essentially, what I do is try to provide what I like to call a more financially nutritious alternative to the mainstream financial media. What's happening in this wonderful era that we're in, where quality information has become so inexpensive. There's a lot of people that have worked very hard in their lives to be making money, generating wealth for their families. Some have been quite successful in that over time, but they are looking around the financial landscape, and there's a lot of things that are making them feel uneasy, whether it's the huge spike we've had in cost of living, whether it's lofty valuations that many financial assets are trading at right now. And they read the Wall Street Journal, they listen to CNBC, and they feel like they're getting more cheerleading of what's going on, more pablum, or maybe even just entertainment, as opposed to really factual, actionable information.
Are you enjoying the show? A quick reminder then to hit the subscribe button so you can be kept up to date about future episodes. Now, back to the show.
And so they're seeking out other sources of better information. And what I try to do at Thoughtful Money is just bring on the experts. And my job is just to bring out as much of that expert story, bring as much of what's in their brain out into the open light for the audience to listen to, and then let folks make their own decisions about what to do with that information.
Sure. And you've spoken to some amazing people. You've been taking this information in yourself every week. It's been, I've certainly found we're only up to our 16th episode of Visiting Compass. The Bullion Baron, Andy, has been doing this for years. How's it been for you in terms of your journey, in terms of the color and the depth of your knowledge that you've got from all these people that you've been interviewing?
Thanks. Today's audience judge what that depth might be as we get into talking about the topics that we've laid out here. But honestly, Jason, the word that comes to mind really is just a privilege. I don't count my episodes, but I'm up somewhere near around 1,000 over the past several years that I've been doing this. And it's been the ride of a lifetime. I don't necessarily consider myself a financial expert, but I consider myself, if anything, maybe an expert of the experts. I get a chance, as you said, to sample all these minds. And of course, I do my own processing through that progress. And if anything, I like to be a reflection, an avatar of the viewing audience. And whenever I start one of these interviews, I ask, okay, if one of the people watching this video were sitting at the table with us, maybe the 3 of us were having a beer together, what are the questions they'd most want me to ask? What are the things that are in this expert's mind they'd most like me to tease out? And so to be able to get to do that on a regular basis with some of the smartest people in the world, like I said, is a true privilege and a true joy. And it does give me the opportunity to listen to a whole bunch of different points of view and then come up with my own synthesis of it. So as we get into that, I'll tell you what the consensus of the folks that I talk to generally is on most topics. I will preface this by saying, though, I've been doing this for a number of years, as I said, and rarely have I seen a time like this one where really smart people can look at the same data and come to different conclusions. One of the things I've been saying to people is if you're listening to all these experts and you're not confused, then you're not paying attention.
Yeah. I always say it overlaps with communication. You're looking at the same bit of data, you're getting something completely different. If I was to just make this shape at a table, if I was to draw this shape on a table, I look at this and I think it's the number 3. The person to my right thinks it's a W. The person to my left thinks it's an M. The person on the other side of the table thinks it's an E. And we're all looking at exactly the same thing. So I hear you, definitely hear you. So I think maybe start with yourself, Adam. Who do you think the biggest loser is going to be in 2025?
Well, I'll start in the financial world, and then if we want to head into other directions, we certainly can. I think one of the biggest, we'll call maybe the group that's probably going to be the most disappointed, is team status quo. right? Folks that have gotten used to back 20 plus years in the markets, who are just expecting we're going to have the same performance in the markets again this year. I think for a whole variety of reasons, which we can get into, I'm happy to drill into the reasons why. I think it's going to be much harder for financial assets to continue rising at the pace that they've been rising at. And I analogize this to make an American analogy, so forgive me, Jason, but if your team wins the Super Bowl, you're thrilled. If they win it again the next year, you're ecstatic, but now you're thinking dynasty. So you're coming into that third year with the expectation that your team's going to win the Super Bowl again, right? Which is statistically highly unlikely. So anything pretty much that team, any performance the team has that year short of winning the Super Bowl is going to disappoint you. I don't know if the markets are actually going to end down in 2025, but I feel fairly confident predicting that we're not going to see another 20+% year. We'll probably see something more on the lines of the single digits. And to a lot of people, that's going to feel really disappointing because they've gotten so conditioned to these recent great years that we've had. And of course, there's potential there for much worse performance in the markets as well. And if we do that, then people are really going to be unhappy. I also think there's going to be a lot of dismantling done by the status quo by the incoming Trump administration. And I don't think that's a huge surprise to anybody. And there have been a lot of things that many people that I interviewed expected to break, that have expected to break, that haven't yet. And I think 2025 may be the year that happens. For example, we had the Fed and many other central banks around the world hike interest rates more aggressively than they had in living memory. The lag effect of that has been expected by many people, myself included. Many people have come to the point that it's not going to arrive because it hasn't yet. We're seeing it's getting harder for the Fed to continue cutting here. So the pace of rate cuts may be a lot slower than the market initially expected. Bond yields have gone up even while the Fed's been cutting. So it doesn't really matter. Higher for longer doesn't matter so much on the short end of the curve that the Fed controls. It matters on the long end of the curve, which the Fed does not control. And the longer we're at higher for longer with longer dated yields, the more gravitational effect that's going to have on the economy. And we're going to start seeing GDP slowing. We're going to start seeing things like the unemployment market, which has really been the big bulwark between the economy and recession. If that starts cracking this year, and maybe that's something we can talk about a little bit in this discussion, that could really be a game changer again in a way that's not going to be fun for team status quo.
No. And just so those people who don't understand these phrases like long end of the curve and stuff like that, what we're talking about here, these longer term bonds, is that right? The treasury issues, when they're trying to raise this money, this debt that they've got to, is it $37 trillion now and counting, an extra $1 trillion every 100 days or something, that when they're issuing those notes, those effectively, they're borrowing money off the world, that people the demand for them, those loans, is decreasing. People don't want so much US debt now. They're worried about the size of the government debt. They're worried about all kinds of things. And so to attract them, they're having to offer increased interest rates. Is that right?
I think it's a pretty good way to succinctly explain it. Yeah, I think the key thing to note is we hear about the Federal Reserve, which is America's central bank. And that basically sets the price of money. And it does that by monkeying around with its policy rate. But that really only affects the debt that the US government issues on the short end of the curve, meaning like really short-term debt, like debt that's exists for weeks or months, maybe a year. When borrowing goes on around the world, yes, the US government borrows all along the curve, but a lot of its debt is further out on that curve. And that gets impacted by foreigners' willingness to buy or not want to buy the debt, as you were saying, Jason. But also importantly, corporate America doesn't borrow based upon the federal funds rate. It borrows basically on rates that are set more or less off of the 10-year US Treasury. That's the foundational benchmark that corporate America uses. And again, maybe we'll talk about this a little bit more coming forward. But as the Fed started hiking interest rates, understandably and practically, corporate America said, okay, it looks like debt's going to start getting more expensive. Let me start taking on as much debt as I can right now while the cost of debt is low. And it stocked up on debt during the COVID era, coming out of the COVID era, right as the Fed started hiking rates. And so the debt that's been on corporate America's balance sheet has been relatively low the past couple of years, even though interest rates have gone a lot higher, corporate America hasn't had to refinance. It's just been sitting on that debt that it took out at low interest rates. And now a lot of that debt, an increasing amount, is coming up for maturity, coming up for renewal. And therefore, the companies have to go back and say, okay, that loan I had is now expiring. I got to take out a new loan. And in many cases, the cost of that new debt is like twice than what the company had on its balance sheet. And the future of the economy is basically based on the future of corporate earnings. And all else being equal, if the cost of your debt on your corporate balance sheet goes up, then your interest expense on your income statement goes up and your earnings shrink. And so as corporate earnings shrink, GDP starts shrinking. That begins to be the progression with which you could go into recession. So that's why this is so important.
And maybe that's why you're seeing insider sellers right now at a 6-to-1 clip to buyers, where Bezos has sold $12.5 billion of Amazon alone in 2024. Zuckerberg, almost 200 million of Meta stock. Nvidia, about 2 billion from their insiders. And that's exactly right. I just wanted to also jump in for one moment and comment on the recession that you mentioned and dovetail that into, I agree with you. So many experts are saying so many different things. Some say recession, yes. Some say recession, no. And when you look at it, so many of the things that typically would be hallmarks of a recession, an inverted yield curve that then re-inverts, the year-over-year percentage in unemployment levels, which has turned negative, and that is a precursor, almost a near certain precursor to a recession. The Claudius Somm rule, where an economist who said that if the unemployment rate increases by at least 50 basis points, 0.5%, relative to the previous 12 months, it's triggered 9 recessions in a row perfectly. Total assets held by money markets, as those go up, typically portrays a recession. We're at a record almost between 7 and 8 trillion in money markets. Delinquencies on credit cards, record high. That portrays a recession. Every single metric says recession's coming, yet half the people say, no, there's no recession coming. No, you're wrong. So to Adam's point, very astutely, yeah, it's a confusing time. What used to be a sure thing, not so much anymore, and makes people wonder what's going on.
Mm-hmm. But I think, I've said this before on the pod, you got to look at the recency bias that exists within the people running the world at the moment. And you find out that a 36-year-old wasn't even financially interested in anything, because they were probably only about 17 years old when the 2008 global financial crisis happened. So how can we expect them to be able to flip out of that recency bias? And as far as they're concerned, everything's good. And you got the stock market at all-time highs, etc. And they have no concept, they have no feeling. I felt the recession back at the end of the 80s and stuff. These younger people running the world, if you're an investment banker and all of that, they have no idea. They have no idea what that felt like. Intellectually, they might, some of them, be able to think about it. And of course, you've got the stock market being pulled up by these 7 large companies. And I was listening to somebody the other day and pointing out that these are very good quality companies that are pushing the stock market up. But even if they have a 10% drawdown, that 10% drawdown in their stock represents now such a huge amount of money. And the interest rates, if they were to, the debt now that they have compared to 20, 30, 40 years ago for the whole of America, consumers, corporates, the government, is now so big that even to say a 5 or 6% interest rate has a much bigger effect on the whole country than it would have done, say, a small change 30 or 40 years ago.
I totally agree, Jason. Let me just jump in to comment on the headline that was just on the screen there. And actually, if you guys can pull it back up, that'd be great. So right now we have this dynamic where everybody is in the same pool, right? If you look at on an earnings basis, almost all the earnings growth in the S&P is in the Magnificent Seven stocks. Similarly, the concentration of market capitalization in its percent of the S&P 500 is the largest it's ever been in the smallest number of stocks. Again, these sort of Magnificent Seven. Now, if you look at the US's share of global market cap, it's the highest it's ever been, right? So the entire world has basically come to the US market because this is where the best party is right now. The entire US market is pretty much all in stocks, and that stock market is pretty much concentrated in just a very few amount of stocks. When you look at retail participation in the stock market, it's about the highest it's ever been. When you look at the percentage of stock exposure that senior citizens in America have, it's about the highest it's ever been. So basically, everybody is pinning their prospects on 7 to 10 stocks when you really look at it this way. When you look at the explosion of ETFs that's happened over the past decade, the concentration of ownership amongst those ETFs is the highest it's ever been in the smallest number of stocks. And again, they're all these same 7 to 10 stocks that we're talking about here. The point I just want to underscore here is that if something goes wrong with those 7 to 10 stocks, it's going to take absolutely everything down with it. And I'm not sure the world really understands how much of its prospects are revolving around so very few. And as you mentioned, Jason, valuations right now are about as stretched as we've ever seen. Cyclically adjusted PE ratios are at a 38% multiple. It's only been that high, I think, once or twice before. I think it was right before the 2008 crisis, but it might be .com. I'm doing this from memory. The Buffett indicator has never been, it's at an all-time high. Stocks have never been this expensive as measured by the Buffett indicator. It's over 200% now. There's something called the euphoria meter. Believe it or not, that exists. That's the highest it's ever been, at least in the data set I've seen, which goes back into the late 80s. We have never seen people this concentrated in this few stocks and this enthusiastic about it. And guys, extremes are called extremes for a reason. They don't last forever. They eventually revert. So if they revert, and it just ends the party, let alone causes a major correction in the Magnificent Seven stocks, that's going to send shockwaves through every market around the world.
Yeah, and it's very true, because if you look at it in an analogy, someone once gave me a cool analogy, and they said breadth is really important, and markets are strongest when they're broad and weakest when they're narrow to just a handful of stocks. But he said the chances of failure are above average when the breadth is very low, that the market cannot continue to rally with just a few large caps. And he said, consider the large caps the generals in the military sense. They lead the way. But the small and mid caps, which are a broader measure of the economy, they're the troops. Troops must be on board to give the rally credibility. And so what you basically have is a handful of stocks leading the way, but the Wilshire 5000 or any of the larger metrics will be a broader base reflection of the economy at large. And if they're all underwater, what does that really tell you? It tells you that is a market that is very dangerous, and one that history has shown, especially with all of the indices and overvaluations that Adam just mentioned, on top of the recession looming, on top of the fiscal irresponsibility, on top of all of these things, that it's very strange, because the euphoria, as Adam is talking about, is at record peak levels, and to a degree, justifiably so, with the new administration. After living in 4 years of bizarro world, I get it, but I think that caution is something that has been thrown to the wind right now, and may not be the best time to do that.
And to your earlier point there too, Andy, euphoria is off the charts, as I mentioned, but that's amongst the market in general. When you look at the people who understand these companies the best, the insiders, the corporate executives at these companies, they're selling, and they're selling at a record rate. Jesse Felder, who I had on my program not that long ago, tracks this. And the only time corporate insiders have been selling at this rate, the sell to buy ratio has been at this level, was right before the .com bust.
And it's really not hard to think about. If the three of us own three separate companies at 3 of the 7 companies, and we're dumping stocks, dumping our own personal holdings, what does that say to the prospect we believe of our own companies? And it's funny, because this kind of information you don't find on mainstream unless you, like we all do, dig in order to be able to be somewhat intelligent speaking to the world. And when you see a 6-to-1 spread between those buying on the inside or selling versus buying on the inside, that should be like ding ding right there, front and center, on top of the Buffett indicator being at the most distorted it's ever been, on top of him having 48 or 9 billion in cash. The whole thing should be alarming to those paying attention.
Yeah, Buffett, if you don't know who he is, he's one of the most prolific investors in the world. His company, Berkshire Hathaway, I thought it was 325 billion. Is it more than $400 billion worth of cash or cash equivalents that he has now taken out of the stock market? And I don't think Jeff Bezos needs to sell his stock just to buy his next yacht. He's got plenty of money. He doesn't. Why is he doing that? You got to ask these simple questions. Why is Buffett sat on all this cash? Why is Jeff Bezos doing it? You got to wake up, guys. You got to smell the coffee.
I agree. And it's not just because we're talking about precious metals or any of these things.
No.
It's just that I think people are being a little bit irrationally exuberant. And I hate to use that overused phrase, but it's true. And after living under the conditions we all did for the last 4 years, it's justified. We want to get our culture back. But be careful, because I keep using the Shawshank Redemption term, where Andy Dufresne had to crawl through a long tunnel of crap to get to the other end. Mm-hmm. And I think there is another end, and there is reason to be optimistic, but we still have a tunnel of debt to crawl through that I think will certainly dampen that euphoria before things are all said and done.
So I very much agree with you, Andy. And this is one of the things that I've been telling people in the spirit of today's video, looking into 2025. What do we see ahead? Markets are euphoric, as we've talked about, and not the only reason they're euphoric, but a reason for the recent spike in euphoria we've seen has been Trump winning the election and people saying, okay, he's going to have a bunch of really economically friendly policies to drive growth. So folks are, animal spirits have been running wild as a result of that. We have to understand that A, there are a lot of problems that he's inheriting, right? B, the economic policies that he's announced are pretty disruptive, right? And so they're not going to come without a price. There's a lot of dismantling. There's going to be a lot of, whether it's the threat of tariffs for other countries, whether it's going to be gutting federal bureaucracy, whether it's going to be deporting millions of people that are employed in this economy, whatever side of the legal immigration perspective you fall on. A fact is that a lot of these people work under the table for a lot of key industries in America. If Trump is actually successful in generating the long-term economic boom that he wants to create, and I hope he does create it successfully, there's going to be some hard medicine that we're going to be taking at the forefront of this. And that's something that I think the market is just not pricing in at all right now. So I do think there's probably a better than average potential for Trump's inauguration to be was it buy the rumor, sell the news type of moment, where reality begins to sink in, that people say, okay, we're the dog, we caught the car, great. But there's actually going to be some pretty heavy lifting before we get the long-term results that we're hoping for.
Couldn't agree more.
And I think some of those losers for 2025, of course, are going to be the government service providers, aren't they?
Yeah, if Doge is successful in what it's trying to do, yeah.
My mother-in-law was actually speaking to me at Christmas, and she said to me, oh, Jason, you've told us this all before. And we've talked about this before, how timing is a difficult thing to get. And it's been unbelievable about how long systemic fundamental problems with the economy have been allowed to continue. And in the past, of course, that's been powered by a hose pipe of money that's been pumped into the economy, which of course the biggest companies in the economy have been able to benefit most. Hence why those magnificent seven have been able to borrow any kind of amount of money they want to. Anybody who's a large business has been able to borrow money. An individual has been able to borrow money if they're already wealthy. But of course, there are reasons, aren't there, why the governments and the central bank can't exactly necessarily do that going forward. Would you agree?
I agree it's going to get harder for them going forward. I don't think we should expect that they're going to change their playbook immediately. I think they'll probably try to do everything they can to keep it going until they can anymore. But I don't know, Andy, I'm sure you've got plenty of strong opinions on this too. But we're already beginning to see it here in the US, right? Where the Fed would love to do its regular playbook and cut rates aggressively again from here. But inflation is just proving stubbornly sticky. So I think that once the inflation genie is out of the bottle, it really diminishes the central bank's prospects. And unless a big recession arrives, which will get inflation under control, but not in a way that folks are happy about, and then the central banks will probably return to their super stimulating playbook, potentially making inflation worse in the long run. I do think it's going to be harder for the central banks to go back to the golden era that they've had over the past couple of decades.
Yeah, I agree. The bond market is getting nervous because inflation concerns are reemerging. In my mind, they never left. But I do think a scenario of higher inflation by the end of 25, and I think that's going to wreak havoc on the debt market. And this is, to me, one of the reasons why you're seeing such a push into cryptocurrencies, because all of a sudden the pivoting from guys like Trump, who thought it was a scam, now to somewhat embracing it publicly. If you look at the amount of treasuries that all the stable coins are accumulating, in essence, supporting the legacy system, it reeks of desperation to me a little bit. But yeah, I think the Fed has not won the battle on inflation. They're 65% away from their target rate right now, and they're lowering rates, which is more or less waving the white flag on it. And the inflation level that we are told is so far off from reality. I wish inflation was only just under 3% or 3%. Right. Quite frankly, it's ask John Williams of shadowstats.com, which I think more people should follow his work. He says at an 8 to that, we're closer to 11% inflation. We always talk about inflation, but the bottom line is that just look at, like you had mentioned, Adam, the economy that Trump is inheriting. The first 2 months of the year represent the worst 2 months that the Treasury has ever had, starting 2 months in its history, of in debt about $900 billion. It took until 2009 to do that in a full year. We've done it in 2 months. This fiscal irresponsibility is growing by the day. And so, yeah, but balance the budget altogether. Say Doge comes in and just slices it all. The Congressional Budget Office says by 2031, even with a balanced budget, 100% of tax revenue goes just to pay the interest on the debt and the mandatory entitlement programs like Social Security and Medicare and Medicaid, which aren't even on the balance sheet. They're off balance sheet. How do we pay these massive 170 trillion in off balance sheet obligations to the American public? And how do we do that without printing money? Who's going to want to continue to buy our treasuries is the big issue. And these are all things that lead people to saying things like, geez, could we be on the way to a reset? Maybe we are. What better person to bring in than the master of the bankruptcy and restructuring than President Trump? And there's a fine line between conspiracy and reality, pessimism and reality. And this is the most confused I've ever been in the last 4 years, trying to figure out how this all plays out. I guess I'll say something that people might get mad at me for saying, but I'll say it anyway. And the question is Trump on the Trojan horse, or is he the Trojan horse? Is he riding it, or is he? And if you don't look at things through this kind of a skeptical lens, I think after everything we've seen over the last 4 years, I think you missed what we have all just lived through. So I'd like to hope, like most people, that this is the time to be optimistic. But you're right. There could be some bumpy things ahead. And I think it's really important for people, if you're sitting on profit in cryptocurrency, if you're sitting on profit in the Magnificent Seven, profit's not a 4-letter word. Don't just sit on it because you're afraid to pay taxes when the insiders are selling at a 6-to-1 clip to buying. It may be time to harvest some of that profit, put it in things like gold and silver, put it in tangible items, commodities, pay down your debt, do these things now while the market is still in your favor. I'm cautiously optimistic for sure, but I do think that there are some hefty hurdles yet still to clear.
Agreed. And just to underscore one point you said there, because it's directly related to your world, Jason. Jason, as I said, I think the central banks are going to find themselves having tougher sledding ahead. Andy said, look, here in the States, but this is, I think, true for a lot of other central banks. It's, hey, demand for our sovereign debt is weakening. Why is it weakening? Other central banks around the world are making the choice that rather than owning U.S. treasuries, we probably should own something else. And what is the something else they are turning to, right? It's gold, right? And some of this is don't listen to what they say, just watch what they do. If that's what the major central banks around the world are saying, that may be, if not the preferred asset to hold, at least one that is preferred versus treasuries on a relative basis right now, which used to be the safest asset in the world. Maybe we as individuals should have some exposure to that too.
Yeah. 100%. And you were talking before about the challenges with the interest rates and recession and increasing unemployment, and presumably that has a negative effect then on commercial real estate and residential as well.
Yeah, look, commercial real estate, I don't think anybody needs me to tell them that commercial real estate's in a world of hurt right now. And I'm not an expert in that space. There may actually be some good values out there right now if you've got a decade plus long perspective, because there's definitely lots of properties out there that are playing on pennies for the dollar right now. But there's a lot of defaults that are going to have to happen in that space that have not even really begun to ripple through the system yet. And that's another thing that's going to weigh on the future as well, future stability. What will that do to the banking system as those debts get written down and have to become realized? But on the residential housing market, which I think is more relatable to more of your viewers here, that's another thing that I think is going to probably feel quite different in 2025 than it's felt in the past several years. We had mortgage rates increase at a dramatic rate over the past several years. Folks were holding on thinking that the Fed was going to start cutting interest rates. That was going to bring mortgages down. Surprised it hasn't. In fact, mortgage rates are higher now than when the Fed started cutting interest rates. But the housing market itself, on average, at least nationally here in the US, prices haven't come down. It's not the sign, though, of a healthy market. It's basically a frozen market where transaction volume has dropped to the lowest in recent memory. And it's essentially, painting with a broad brush here, but it's essentially the wealthy trading properties amongst each other. And so that's keeping average prices high. But as time goes on in the story, time is not the housing market's friend here. As mortgage rates continue to stay where they are and prices continue to stay where they are, first off, we've never had home prices be this unaffordable for as large of a percentage of aspiring buyers in America as they are right now. So we've got a record percentage of the population that's just priced out of owning a house. As time goes on, you start to have motivated sellers too, where people just, some percentage have to sell their house for some reason. They die, they get divorced, they get forced to move because of their job, they lose their job, right? So those
Gets renewed. They have to go to a higher percentage.
right, if they're on a variable rate mortgage. Yeah, America has a much higher percentage of fixed rate mortgages, but there are people out there that still have variable mortgages. And this is actually very relevant to every homeowner. The cost of homeownership has gone up. So even if your mortgage rate has been locked in, your insurance has gone up by a lot. Your cost of maintenance and repairs have gone up by a lot. Your property taxes have been assessed higher. If you're just making the same amount of money, but those costs are going up, you're getting squeezed more and more as time goes on. We've got that sort of lit fuse going on. Now, we also have had in the recent decade a much higher percentage of investors buying single family homes. These are, yes, mom and pop investors who got into real estate a little bit more aggressively than they had in the past. But it's also been people who caught the short-term rental boom during COVID. Everybody said, hey, I'm going to go buy Airbnb properties because everybody's doing revenge travel now that COVID's over. And I'm going to become a passive millionaire from all these rental properties that I'm scooping up. Then you had big players, the Blackstones of the world, coming in and just buying up thousands of houses, oftentimes within the same metro. So you got to understand, for those investors, owning the home is not a keeping a shelter over my head decision. It's simply an Excel decision. It's, hey, we thought this thing was going to return a certain amount of cash flow. It's not. So let's get rid of it. We're beginning to see that inventory begin to flood into certain markets, particularly those markets which were the most hot leading up to the recent years. These are what we call the sunshine states in America. It's where Airbnbs are the most plentiful. It's where the developers were building the most homes. So now we have the developers still bringing inventory onto these markets right at the worst time as they're beginning to soften for all the reasons I mentioned. Plus, these investors beginning to dump their properties. Plus, these just regular homeowners increasingly not able to afford the homes that they have over their heads. So the key thing here is inventory. It's been really tight up until recently. And now in an increasing number of markets, we're starting to see huge spikes in inventory. Now, in many cases, like in Texas and Florida, and a lot of markets there, a lot of metros there, the inventory is now higher than it was pre-COVID, right? And the trajectory is still going higher from here. So that's like a contagion that is beginning to spread into more and more states. And so unless one of two things happens pretty dramatically in 2025, unless we see mortgage rates really come down pretty aggressively, which I don't see happening anytime soon on the radar, or in case, except local incomes start really skyrocketing, we're going to have some sort of reckoning in an increasing number of metros in America where the only way to get inventory moving is going to be lower prices. And it's going to be painful for a lot of homeowners, but it'll finally start providing some relief to aspiring home buyers who have been so frustrated in recent years that they just haven't been able to get into the homeownership game.
The majority of the homeowners these days are locked into 30-year mortgages at 3 or 4%. And you can't travel with your mortgage. In other words, you try to move laterally and lock in some of that profit and price. The reason prices haven't come down is that people paid much higher prices at much lower interest rates, and they haven't come to realize that relationship between higher interest rates and asset prices, and that they failed to realize that truism, which will hit them in the face at some point. Because as Adam said, we've lowered the federal funds rate by 100 basis points and the 10-year has gone up the same amount. And that's what the mortgages come off of. And so, yeah, it's a situation very tenuous in the residential, which ought to get worse, I think, in terms of house values coming down as more and more properties hit the market to the degree that Adam said. But let's not also gloss over, I know we talked about it for a moment, but the delinquency rate in office mortgages that have been securitized into commercial mortgage-backed securities spiked to 11% in December. That's an all-time high. That's higher than the great financial crisis of 10.7%. And so you have an additional, just in December alone, $2 billion in commercial real estate office debt became newly delinquent in December alone, $2 billion. So you're beginning to really see problems with the commercial real estate market that is owned primarily 70% of that debt is held by the regional banks. And a lot of it has been commercial packaged into commercial real estate mortgage-backed securities. But yeah, we haven't begun to see the end of that problem yet. And it's great to have a 3% mortgage. But if you lose your job and can't service your 3% mortgage, that's when, as Adam says, you become one hell of a motivated seller. Yeah, the commercial real estate and the residential real estate story has yet to its final chapter.
So two things on that. So I totally agree with Andy. And Andy, what is expiring in April, right? The BFTP or BTFP?
It expired in March, but it's empty in April, meaning that the loans up, they could write loans up to March, and then by next March, done.
Who's that? Who is that?
That's the BTFP, the Bank Term Funding Program that came in to save all of the banks last March and April when Silicon Valley and Signature Bank failed. It's the rescue, if you will, to the ailing banking industry. So what he's saying is that as the banks get more and more pressure, there's nowhere for them to get bailed out.
Too, on the residential side, we are seeing delinquency rates start to tick up too. There have been a lot of forbearance and other programs that had kept that from having to move the way that we've seen delinquency rates rise sooner in credit cards and in auto loans, but it's now starting to happen in mortgages as well. And if we get to the point that Andy was just mentioning, where sellers begin to become really motivated and people start dumping their properties, rushing to list their properties, then if we get to that point, then there's a negative wealth effect, right? Not every American household owns stocks. In fact, I think it's the top 10% of households own 93% of financial assets here in the States, but housing is much more widely owned. And so if people really start worrying about either the fact they've got to sell their house and they're going to get less money than they expected, or just that housing prices in their area are coming down and the house they own, they're watching their home equity shrink, they're likely to start changing their consumption habits. And that in itself will start reducing corporate earnings because we're a 70% consumer spending GDP. So that could be an important factor in leading us into a recession.
Right.
And of course, there's other reasons why people might lose their jobs. And a lot of people have had a lot of confidence, and some of that exuberance that we talked about, that irrational exuberance that we saw pump up markets in the dot-com boom and now pumping up those magnificent seven. A lot of those magnificent seven, their stock prices have recently had a surge because of AI. But I think that one of the losers for this year could be OpenAI. They've been the darling and the first mover and the breaker, so to speak, out into the market. And their valuation's gone to ridiculous levels. Because, of course, there's a huge amount of opportunity that can come from this type of thing. But suddenly Google, Musk's XAI, and even Microsoft, who have partnered with OpenAI, they've all caught up or catching up very quickly. And there's all kinds of, I'm waiting with bated breath what they're going to be coming out with next. But at the end of the day, this is already having a productivity effect on most individuals and businesses that I know, certainly here at Glint as well. We're doing everything to use the power of AI to increase our efficiencies, be able to improve our client services, get back to people faster, etc. Do things faster within software engineering. But at the end of the day, that's going to be taking jobs away, isn't it?
Mm-hmm. I think it's very hard not to see AI as a long-term jobs killer. And look, there's something that has been known forever in economic theory. Keynes referred to it as the issue of technological replacement, which is if technology can do a better job than human labor, you should replace the human labor with the technology. But you have to be very careful about the pace at which you replace the human labor. If you replace the human labor much faster than you're able to repurpose that human labor to additional constructive use, you end up creating a societal problem, the cost of which oftentimes is bigger than the gains of the technology, right? Mm-hmm. And I think that's one thing with AI where we're just running at it at breakneck pace. And I don't think we as a society have said, hey, if this ends up displacing millions of workers, what are we going to do about that? Right. To another point too is, look, I don't doubt that there's going to be a lot of benefits coming from this most recent boom in AI. And I'm not an AI expert, but I've talked to enough that they really do want to say, hey, look, the type of AI that we're talking about, these large language models and whatnot, it's not true artificial intelligence. It's an evolution of the technology that we've had. It's not revolutionary the way that some people think of. And there are other forms of AI that are focused on that. And so I think what they've said is, look, the euphoria around what AI is going to deliver, the current generation of AI is going to deliver, is highly unlikely to be met by the profit increases we're going to see in corporate America from this. And I'm not a big enough expert to know whether that prediction is true or not, but we've spent hundreds and hundreds of billions in corporate America investing in AI right now. And to date, we haven't seen nearly that type of benefit at the bottom of the income statement. And now maybe over time we will, but a lot of the technologists that I talk to compare this to the dot-com bubble in the sense that, hey, look, the internet actually did deliver eventually on expectations, and in some ways even more so than what we initially thought, but it took an awful lot longer than we expected. And so we had, given our enthusiasm, we brought tomorrow's market value in, back by the end of 1999 into 2000. But then it took forever for that to really be fully realized in the market, which is why the NASDAQ corrected and basically we had a lost decade in it. So I think that's one of the risks here, which is, do we have, again, a buy the rumor, sell the news type of event in the AI stocks where folks just say, hey, you know what, it's going to take a lot longer for the trillions and trillions in market cap that we've already given these AI companies over the past couple of years to come to fruition. And therefore, we need to bring down their multiples, or at least we need to hold these stock prices steady for a long time.
Yeah. Silicon Valley would say, oh, it's going to drive 5% increase in GDP and it's going to be the savior. And actually what Trump's doing, making all these cuts, cut out all the fat within the system, all the inefficiencies, but let's use technology to drive up GDP. That will be our savior. We'll grow ourselves out of the $37 trillion worth of debt. I don't see it either. But I do see the long-term, this issue of how fast AI grows and develops is crucial, because I've talked about it on our show before. I've seen what happens for instance, when shipbuilding leaves a city, and I've seen what happens when coal mining gets shut down in towns, and you get left with whole generations of people that are just too old to retrain. Generations, and they just end up with just really dead economic zones.
I had a great grandfather who was, and I learned about this through genealogy, I didn't know him personally, but who ran mills in New England. And I went up just to do some family history research and found the town he worked in and where the mill was, which has long been shuttered. And the town never recovered. These mills went dark in like the 1920s, basically. And the town still hasn't recovered 100 years later.
No. So listen, why don't we talk a little bit about what we think are going to be the winners for 2025? We've talked a lot about the challenges, about the problems that we might be seeing ahead. And obviously we need to understand the problems in order to be resilient and better to be prepared than to be caught out. But what do we think are going to be the winners?
It's going to sound like I'm trying to pander to my hosts here, but I actually think that gold will do really well. I see more of the sort of a combination of safety trade for all the reasons that I talked about, why I think things are going to be a rockier road ahead for most financial assets. But I think in many ways, the public, what they say, inflation is the tax that not one man in a million can see. And I think that's true in general. But I think we have woken up the populace to currency debasement, how the current system, the way that it is run, its intention is to debase the currency over time. It's just to do so in a way that doesn't get the people running the system in trouble. But given what we've done to the cost of living, how badly we deformed it coming out of COVID, I think we woke up the populace's eyes to the fact that, hey, this system really isn't being run to my long-term benefit here. And I got to start finding ways to protect myself from this vulnerability we have to continued injury in our cost of living, given what the higher ups are doing. And I think we're going to see more and more people, just like sovereign governments are, turn to time-honored solutions like gold. So I think that's one. One, I think, is we're seeing this underway, but I think this is important. And actually, this gives me some hope in the long term. We are seeing a turn away from globalism towards nationalism. And I think you can have a healthy debate about whether that's good or not. But I think for the average person, at least in the average Western country, I think they look back on the past decade or so and say, you know what, like the people were really thrown under the bus for a lot of priorities that our leaders were making that we didn't really see how they benefited us as just the rank and file populace of this country. And we're not willing to have that anymore. We're not really to stand for it anymore. We want to see policies that are actually going to reflect our interests and our priorities. And we've seen this in a wave of elections across much of the West, where the standard bearers for the New World Order, globalism, et cetera, have been pushed out. And the most recent example of this is Justin Trudeau in Canada yesterday, who just announced that he's stepping down. But obviously Trump won here in America. We've seen government replacements recently in France and Germany. Obviously Italy went through theirs. We've seen Milei in Argentina. He's been giving a lot of hope to a lot of these new leaders here that, hey, we actually might be able to get a mandate from the common man to come in and deploy a lot of these more nationalistic, what is this going to mean for the betterment of our people policies going forward. So I'll let folks debate which side of that they fall on. But I think if you're for ending the war on the middle class, the war on the general populace, I think if you're on that team, I think you're going to feel much more like a winner in 2025 than you felt in the past couple of years.
Yeah. I think one of the challenges is around the changes that Trump wants to create, the cuts that he wants to make in the government, et cetera. There's going to be a lot of people upset by losing their jobs. And obviously, we've talked about recessionary effects that are going to mean people are losing their jobs, unemployment going up. And what I worry is that we're going to see a lot of social unrest and actually a move towards socialism. He in Argentina, he had the benefit of an extreme amount of pain in society and in the economy, which has allowed him to make these drastic changes to how their country works. Huge amounts of society have lost their jobs. The government's completely, bloated government's been slashed. He's managed to get it into, I think, a budget surplus within 1 year, like a phenomenal exercise. But he wants to make these cuts because this debt, this $37 trillion worth of debt, hasn't until recently starting to show some effects of maybe coming into problems. This debt hasn't really affected the average person, has it? $37 trillion, so what? We can add another $10 trillion on. That's maybe the attitude of a lot of people, but hasn't really caused a huge amount of pain. So how do painful cost cutting, how does that happen when people are not in the pain?
So I think that's such a great question. And Andy, I think you and I might have talked about this a little bit in one of our last conversations. But so I agree with you that Trump needs to make a huge part of his communication priority to the American people as soon as he gets sworn in is, whoa, folks, this is way worse than even I thought. It's going to require a lot of shared sacrifice for us to get to where I want us to go. Thank goodness I'm here. Here's my big, bold vision. But we're going to have to tighten our belts. And we're going to have to endure some rough years to get from here to there. To be honest, to the spirit of your question, I don't even know if that's going to be successful. America isn't the America it was 100 years ago, right? Where the greatest generation, made huge amounts of self-sacrifice to save democracy around the world. Americans we're not great at self-sacrifice right now. We all want the easy button. I think there is a uncomfortably high risk that whatever pain we take, whether it's been pre-messaged or not, is by the time the next election rolls around in just 4 short years, we have a lot of Americans that are smarting from the medicine we need to be taking, right? And they just say, this sucks. I'm just going to vote for the person who's going to promise me free stuff. Right. And then that's where democratic socialism gets in the door. I really hope that's not the case. And I don't think that's not a reason not to try to do the painful reforms that are necessary. But I do think, to your point, Jason, if Trump doesn't start communicating that soon, it will probably come as a massive disappointment to the masses that are very enthusiastic for his next administration. And it's going to feel like a bait and switch. Hey, you promised us this big, beautiful economy, but I just lost my job. You're a liar. I'm going to vote for the guy who's promising something different. And in most cases, if it's a democratic socialist, the guy who's promising to give me free stuff, that sounds good.
Yeah. Let's keep on the winners. Let's keep thinking about the winners. Who are going to be the winners?
If I had to guess, I would say clean energy. Probably not so much like it was under the previous administration. I think instead I would look at infrastructure like steel and cement and related sectors. I would look at technology companies that focus on innovation and digital infrastructure. And of course, defense spending like aerospace, military contractors, manufacturing and domestic production, as small as it is. I think there will be benefits there. And of course, natural resources, drilling, oil and gas, precious metals, the loosening of regulations, regardless of what President Biden just did yesterday to make it tough on. I think, to me, those are the places that you would look at from an equity standpoint. If you were
I don't disagree with you. I think from a technology perspective, trying to bring manufacturing and resources back onshore is going to really benefit those manufacturing hardware in the USA, especially as well, if you combine it with the AI boom, and if that was to continue, the sheer demand for compute, for the ability for computer processes and systems, is all concentrated in one company. Most of that being a lot of that being manufactured in Taiwan, which of course we know for geopolitical reasons that there's a lot of concern around China's ambitions for Taiwan and stuff. So we're tactically, I think there'll be a lot of focus on trying to bring all of that onshore. It means a huge amount of build out that's going to have to happen in the US when it comes to software to hardware processors for that. Even if the AI companies like OpenAI, if their valuations come down because of effectively the intellectual software side of AI becoming commoditized, it still needs that hardware compute to make it happen, to make robotics happen, to make self-driving cars happen and stuff like that. So you've got potential for these big companies like Amazon or Tesla to want to acquire the ride-sharing apps or the Ubers or the Waymos or even the food delivery companies, etc. You've got autonomous delivery drones now, but wanting to be Amazon trialing those out and delivering those things out to the community. But for me, I think that the biggest winner for 2025 is going to be the movement to make for sound money. We've got 20 US states now into their second year of planning and to roll out sound money legislation around gold to enable gold as legal tender. 20 US states. Utah, last session, they approved their Treasury Department to run a study bill into the whole thing, which is actually complete and published by the State Treasurer's Department just a few weeks ago before Christmas, where they're recommending to the legislator that the legislator does vote in the ability to enable gold as a legal tender, as a medium of exchange, as a payment mechanism. And to not only just do that, stand up a platform to be able to run this for people. It's phenomenal. And Jimmy Petronas, who's the CFO of Florida, he just announced recently that they're launching a study on gold and silver as legal tender as well. And this is phenomenal. It's happening under the radar. Kind of no one's talking about it from a mainstream perspective, which I'm quite happy about. I'm happy that these people don't have any targets on their back from the big national banks who might not like it, even though they should, because they should be embracing this and integrating with it. But I think that you could easily see next year a state like Utah, Florida, Texas, and even smaller states like Kansas, Louisiana, all passing legislation to make gold legal tender. And I know people have heard this before. Didn't 2011, didn't Utah already make something legal tender? Yes, they did, but they made these, the gold coins legal tender. And of course, the IRS were out there saying, well, these gold coins, these gold eagles and stuff, they're not really money, are they? You have, you can't use them to pay for your coffee. And so, yes, they're legal tender, but they're not transactional. And of course, what the states are doing now is they're saying, we'll use a system like Glint, for instance, or another system. We'll combine that with the legislation to make it legal tender. And for once, for the first time since the Constitution, since gold stopped being legal tender in 1971, that you will actually be able to use gold as money and there will be no capital gains tax on it, because this will be for the first time transactional gold that can be spent in a Starbucks and you can buy your coffee with it. So watch the space for gold legal tender in the US. I think it's going to be a phenomenal opportunity.
Just on that point, Jason, I just want to give credit to you and other players in this space. I know that you've been in some way, shape, or form advising at least some of those state initiatives. There's a quote, and I think it maybe was from Churchill, from your country, but it basically says, in times of crisis, the solutions that are implemented are the ones that are already on the table. And what I see the states doing and firms like yours and helping them is just trying to get solutions on the table so that when we get to a painful reckoning moment where people say, look, we got to start doing something differently, we have good solutions like these on the table to be able to turn to.
Yeah, you're absolutely right. And the study bills and the study groups that have been involved, they've got some phenomenal people on those committees. I think you were testifying as well at one of them, and you saw some of the people who were there, former vice chairmen of the Federal Reserve, former CFO of some of the biggest financial institutions in America, all talking about making transactional gold legal tender and saying, yeah, it's a good idea. Why wouldn't you do it? Or why not? Why? It's insane not to thing. And a huge confidence in the dollar as a medium of exchange. It's still the world's kind of medium of exchange, or in some countries it's not because of sanctions. Their belief is that, well, why can't you save in something? Why shouldn't you be able to save in something that retains its value over time and isn't subject to the destructive effects of inflation?
Right. And something that is encoded in the US Constitution as money. In fact, the only thing that's encoded in the Constitution is money, right?
Yeah. Article 1, Section 10, is it? Article 1, Section 10, Clause 1 or something of the US Constitution says that no state, it forbids any state to make its own currency except gold and silver. There it is on the screen. Go and check it out yourself. You might think it's a little bit far-fetched, but actually these are the country's leading financial heavyweights saying, yeah, we think it's a good idea. And here are very well-respected state treasurers and legislators saying, yeah, we want this. And that's wonderful. I keep saying to Andy, this is the wonderful thing about the US, how the US is set up as a republic, is that the US states are able, through the Constitution, to keep the federal government in check, and the federal government able to keep the states in check. And that balance is potentially coming back because the states are starting to say, actually, we need to take our destiny into our own hands. And as you say, put things in place.
And I actually think part of the incoming administration, wants to add tailwinds to that. And this was one of the things I was going to add to the list of winners in 2025. I think it's going to be the states. A big part of the whole methodology, apparently, behind DOGE is, all right, let's get the federal government out of all these things that we can't, education, health, whatever. Let's return all that authority back to the states.
So there you have the bullion baron state being one of the leading US states in the drive for transactional gold, and just to give people a little glint of hope.
Yeah, that was a good mic drop right there. Yeah. Adam, you're awesome, man. You're a plethora of information and you disseminate it in a way that us mere mortals can understand very easily. How do people find out more about what you're doing?
No, you're very kind, Andy. They can just go to thoughtfulmoney.com. We have all of our new content there. If you want to listen to the interviews, there's a link at the top of the site for a newsletter if you want to be kept in touch of all the things that we have going on. And right there on the homepage is the other thing I do besides providing information to people and help them understand what's in the mind of the top experts is I connect them, when helpful, with financial advisors who are like-minded. So many people say, look, I listen to really smart people like Jason and Andy, or some of the guests that are on my channel, like former sitting members of the FOMC, Nobel Prize winning economists, whatever, where they say, wow, I really what these people are talking about makes a ton of sense to me. I'd like to integrate this into my portfolio, but I've got a real life. My expertise is my job or taking care of my family or whatever. I'd like to find a financial quarterback who thinks like the experts on this channel. If you fill out that short form on the Thoughtful Money website, you can get a free consultation with them. There's no strings attached. There's no expectations. There's no commitments. It's just a free public service they offer to try to help as many people as possible position as prudently as possible for what may lie ahead, given all the macro issues that we've just talked about in this past hour.
That's amazing that you've been able to pull together a cohort of financial advisors that actually have had the veil pulled away from their eyes and actually awakened to what's going on. Congratulations.
Thank you. Yeah, sadly, it's a minority of financial advisors out there. Many of them are just in the, hey, look, just go along the market, close your eyes and let the Fed take care of you. But there is a small and growing coterie of advisors out there that have pulled that veil, as you've said, and are doing the real work, right? Which is, okay, rather than just passively just keep putting money in every year, how do you do the active investing where you're going back and doing the gumshoe work of trying to find truly undervalued companies, which is harder and harder to do in this overvalued environment? How do you know when to be in the market versus when to be out of the market? And obviously how to use time-honored practices like position sizing, diversification, hedging to make sure that you're intelligently managing risk through the whole process.
Great, thank you. And of course, just as a reminder, if anybody wants to buy some physical gold bullion bars or silver bars and coins, of course, Andy's business, Miles Franklin, he always open to offer as his continued best service that he offers everybody. Andy, what's the web address for your business?
milesfranklin.com, and to get our price lists that we keep close to the vest, special for Glint listeners and for Adam's listeners, that would be info@milesfranklin.com, where the price list that we will send you with nary any obligation whatsoever, none, would be to your best interest. Prices will be as good or better as anywhere you'll find in North America. And any questions that you've heard on this interview with Adam or any others that we've done, put them in there, no obligation, and we will answer them right back.
Great. And if you want to put yourself on your own personal gold standard and be able to buy gold in silver, actually in tiny amounts, as little as 1 cent's worth of gold or millions of dollars, but we actually want to be able to have it, not just as a store of value, but spend it, good man, then actually you can download the Glint app from the App Store and put yourself on your own gold standard now. But Adam, I just want to say a big thank you from Andy and I for coming on the show. Been watching your episodes for a long time. Big fan of yours, as I'm sure a lot of our viewers might be. If you're not, check out Adam's website, check out his channel. And if you need that advice, please go to his website and get one of those interviews with one of his team.
That's not just placating. I watch everything you do too, Adam, and you're at the top of your game. And I too am honored to have you here with us today and look forward to seeing you at the Vancouver Resource Investment Conference in 2 weeks. And that's a shout out to Jay Martin, where he puts on one of the best shows that I go to.
Agreed.
One of only two I go to all year, his and Rick Rules. But we'll be talking about Glint at that show and look very forward to seeing you there.
All right, gentlemen, it's been an absolute pleasure. Thank you so much for having me on.
Take care.